Hello, Business 330 students. This is Professor Hassey, and this is our week 5 lecture video. A little late this week because we've had some technical glitches between Blackboard and YouTube, which I use exclusively for my work, and had to reload some software and get things going. So I apologize. But this week 5, it's entitled Capital Valuation and Capital Budgeting. We're ending our or beginning our discussion about capital budget analysis, which is going to take up most of our next 3 weeks of our course, is to learn how to determine the return on investment for taking capital, cash, investing it in an asset, and then creating return. And we're going to be starting this discussion with chapters 8 and 9 this week, talking about the net present value, internal rate of return, discounted cash flow. And we have a couple of problems in this lecture to review for that. And you'll be looking at this in other assignments down the line. Also this week, we're going to review assignment number 1 and make sure and introduce assignment number 2, which is due Sunday, July 11th. First of all, let's talk about assignment number 1. Everybody did very well on that. Just a couple of areas where we did drop off, and that naturally happens. My type of assessment, the way I give assignments is I want to designate students who are A students to students who get A minuses or Bs, and that there's 1 or 2 questions in the work that show me a student is really engaged in understanding the material. And I'll show those examples in this assignment. And there's like that in every assignment and every examination. First of all, it's basically a definition assignment. And again, these solutions are in Blackboard. One area where some of us missed was what are the 2 major decisions made by financial managers? And this is taken right out of our text, right out of our lectures. And basically, it's investment and financing. Where to invest our capital, number 1, and how to finance it. Where's the money going to come from? Borrowing, issuing stock, profits. Those are the 2 main decisions that financial managers have to make. The next one is also kind of a jerky type of question, but it proves a point. Which of the following groups is least likely to be considered a stakeholder in a firm? Well, naturally, I would think that would be the competitor. I don't think you want your competition to be a stakeholder in a firm. Remember, a stakeholder is somebody has an investment or gets some type of return off that entity. You don't want any return given to your competition. So that's why the answer is competitors. The government, some of you answered that. The government gets taxes. You provide jobs. You provide taxation. Bondholders, naturally, they are investors, and employees, naturally, are stakeholders. So the answer to that is competitors are least likely stakeholders. Everybody else did. On this one here, question number 6, which of the following information is not provided by the financial markets? Well, the market provides information about prices of commodities or stocks. The market provides information about interest rates and the market rates that you borrow. A market rates determines the cost of services, investments, cost of wiring. But the marketplace does not provide Microsoft earnings in 2002. Microsoft earnings provides that information. Now they provide that information to the financial markets, but the financial markets do not create it. Microsoft creates their own earnings. So that's what I was looking for in this answer. The source of that information. C. The next one is which a lot of us had difficulties on, and it was taking a little bit of your knowledge of accounting, financial statements, and answering a series of key questions that need to be known by financial managers. What is our net income? What is our operating profit? What is our net income? And what is our working capital position, our cash flow from operations? Those 3 things. So we're told in the problem to kind of put these pieces together into determining these 3 answers. Okay. Sales is $500,000. That's revenue. Cash dividends, $10,000. Immediately, you should put a line through this one. This has nothing to do with this problem. $10,000 cash dividend is cash flow from financing. It's not an operating expense. It has nothing to do with the three questions asked in this problem. $300,000 cost of goods sold, that's an expense. $20,000 administrative expenses, that's an expense. $20,000 depreciation expense, that's an expense. And also, it's a source of operating capital. Get to that in a minute. $10,000 interest expense, but interest expense after operations. $10,000 purchase of productive equipment. There you're producing or purchasing an asset. That is not an expense. You're purchasing an asset that's cash flow from investing. So that has nothing to do with this problem also, just like dividends. Dividends and purchase of productive equipment has nothing to do with the three data sets we're looking at in this problem. There's no changes in working capital, which means there's no change in accounts receivable, current liabilities, current debts. Don't have to worry about that as far as operating cash flow. And our tax rate is 35%. So if we take our sales and our expenses, cost of goods sold, administrative expense, and depreciation expense, we get our first number, earnings before interest and taxes. That is called operating profit. You're determining earnings before interest and taxes. The answer, $160,000. From that, we subtract out interest expense, and we get our interest before taxes. So 160,000 minus 40,000 is $120,000. Take 35%, which is our tax rate of $120,000. We get an income tax expense of $42,000. Subtract that from our operating profit, 40,000 interest and 42,000 taxes. We get net income of $78,000. Answer number 2. And then to determine our operating cash flows from operations is net income plus depreciation plus or minus changes in operating assets, current assets, and operating liabilities, current liabilities. There's no changes in working capital, so our cash flow from operations is our net income, $78,000, plus our depreciation of $20,000. Answer number 3 is $98,000. Remember, depreciation is a non-cash expense. So actually, we made a net income of $78,000, but our cash flow from operations was $98,000. Okay? That's my question that separates the A's from the A minuses and how you do that. Question 8, 9, and 10, you all did pretty well on defining the standard measures of financial analysis taken out of chapter 3 and 4. The define a profit and loss statement, which is an income statement. What is it? And in question 10, select one firm from your portfolio and find its earning per share for the last 3 years. How have they changed? So I wanted you to find the earnings per share, and this can be found in a variety of locations for one company. Some of you forgot to tell me the name of the company, so I couldn't really check it out. So make sure you put the name of the company when you're doing any analytical work. Okay. Then in question 11, the same company determined for the last 2 fiscal years current ratio, which is current assets divided by current liabilities, debt ratio, total liabilities divided by total assets, profit margin, which is net income divided by sales or revenue, and return on total assets, net income divided by the assets of the company. Okay, that was our assignment number 1. And again, the solutions are in Blackboard, and they're posted to your grade center in Blackboard. Assignment number 2 is posted this week and due this weekend, and basically it's taking information about the time value of money, doing a couple of basic calculations. And here it is here. I think it's pretty self-explanatory. We've reviewed these in some of our lectures. Also the answers are in your textbook. And I want you, this is a good one. Question number 4, please give example, excuse the typo there, of from your professional or personal life that describes present or future value. Example would be a savings account or something that earns interest over time. Give an example of a present or future value in your professional or personal life. And then I want you to select a company in your portfolio and tell me why the stock price has changed over these last few weeks. Why has it gone up? Why has it gone down? Why has it stayed the same? One page or up to 3, just an explanation of why you think the stock has changed. What give your interpretation of what happens. You can look up or you can give your own interpretation. Okay, that's assignment 2 due this weekend, July 11th. Again, if you need extensions, extensions are available. Okay, here's our, make sure I do this here. There you go. Here's our week number 5 site in Blackboard. Again, remember it's important to stay up together with class, up to date with class, and also by me posting this lecture video doesn't do that justice very, very well, but I apologize for that. But here's our introduction video for the week. Here's our agenda for the week, which you have seen. Here's a brief video explaining capital budgeting, which is a pretty good one. Here's our introduction to the week. Remember, you're only responsible for these pages in your text. There they are right there. Here's the PowerPoint and the explanations of the chapters. Here's a great definition of capital budgeting, which we're going to be studying over the next few weeks, and what we're reading our discussion in chapter 8. And here's some problems which we're going to review and another video. So again, we're talking about the investment of capital in an asset. Okay, here's a spreadsheet that will be included with this lecture video that talks about the key points of chapters 8 and 9. Chapter 8 is how do we measure return? Okay, one of the main reasons why we studied time value of money in chapter 5, and you're doing questions on that this week in the assignment, is to understand that concept of determining the value of money either in the future or in the present. And that's starting with capital budgeting. This is where we use this. This is one of the examples of time value of money. Well, here we're given in chapter 8, problems 1 through 8 at the end of the chapter, up 2 projects, project A and project B. One project has 4 years in length, and the other project is 3 years in length. In other words, length meaning that's their depreciable life of that asset. When you're given the life of a project, you might own the project and have the project for 30 years. But for financial analysis, it's as long, the financial life is as long as you can depreciate it, the depreciable life. So project A has a life of 4 years. Project B has a life of 3 years. In year 0, that's the beginning of the project, they're investing $200 in each project. That's how much the asset is costing. We're keeping the numbers low here. Usually it's in the millions of dollars. But the project is $200 of cash being spent now to buy the asset. And it's estimated, and we will talk about estimating cash flow in chapter 9. That's called discounted cash flow. But it's estimated and given to us in the problem that project A is going to generate cash profits of $80 a year for 4 years. That's $320. And project B is going to generate cash flow of $100 a year for 3 years. That's $300. Now the question is, what is the best investment? What is giving us the greatest return? All right. Well, there's 4 calculations discussed on those pages that I've given you in chapter 8 that define these 4 ways of determining. The net present value method is determining return in dollars. The internal rate of return method is determining the return in percent. The profitability method is determining the return in a ratio. And the internal rate of return is determining it in a percent. The profitability index is determining it in a ratio. And the payback is determining it in years. How long we get our money back. Same numbers, four different ways of looking at it in dollars, percentage, ratio, years. And this is how companies determine whether we should invest in assets or not. Are they going to create a great enough return over what we're spending on those assets? And another key determinant factor of this is, which we'll talk about in later chapters of how to calculate it, is what is our cost of capital? What did it cost us to get the $200? Did we borrow it? Did we issue stock? Did we use our profits and taking that money away from our investors as far as in terms of eating up the profits and spending them? What is our cost of money? In this case, in this problem, it's 11%. It cost us 11% to get the $200 to invest in projects A and projects B. So that's our cost of money. So what we need to do is in the net present value method is compare this cost of money, $200, and the cost of discounting these cash flows back to today at 11%. In other words, $320 is what today discounted back at 11%. And then we compare that to the $200 investment to determine our net present value. So, formulas, function. We've seen these before. Financial, net present value, NPV. There it is right there. Our cost of capital is 11%. And the values, the cash flow being generated is from year 1 to year 4, $80. So all I have to do in this function is just highlight year 1 to year 4, see it there, B5 to B8, and then I hit OK. $248.20. In other words, $320 received over the next 4 years, discounted back at our cost of money, 11%, is worth today $248.20. Compare that to how much we're spending, and our net present value is positive $48.20. And that's a good thing. We're making money. We're making $320, but discount that back at the cost of money, take out the interest and compare it to the investment, we're making $48.20. Let's do the same thing here for project B. Function, formula, financial, net present value. Rate again is 11%. Our values here now are in column C, 1, 2, 3. $244.37 for a net present value in dollars of $44.37. So just looking at this analysis, we would raise our hand, project A is making more money in terms of the total amount of the project. Not by much, but they are. The internal rate of return is, what is this return in a percentage? Formula, function, financial, internal rate of return, IRR. And here all you have to do is paste, put in the values from year 0 to year 4. Notice here we're including year 0. We didn't in the NPV calculation. So it's B4 to B8, and now what the computer or the logarithm is doing is going to compare the $200 to the return into the future, 21.86%. I converted that decimal to a percentage. So this project A is generating $448.20 in dollars, but generating a total return of $21.86%. What's it for project B? Formula, function, financial, internal rate of return. Again, the values are from year 0 through year 3 in this case. 23.38%. Hey, Project B is earning a greater return. Well, how can that be? Project A is earning more money. Project B is earning greater percent? Yes. And here's why. You're getting your money quicker. Here we're getting $300 in 3 years. Here we're getting $320 in 4 years. So we're making more money here, but we're getting the money faster, so our return is greater. And many times companies have cultures. Some companies say, you know what, I want the money back as fast as possible. I want to make more money quicker. Other companies say, I just want to make more money. I don't care how long it takes. Different ways of looking at a return. The profitability index is the relationship of the discounted cash flow to the investment. All right. So in this case, the discounted cash flow is 248.20. Divide that by the investment, 1.24. For project B, 1.22. So naturally, the discounted cash flow amount is greater, thus your ratio is going to be higher. Naturally, you will want a profitability ratio over 1. You want the discounted cash flow to exceed the amount of the investment. And the payback in years is not doing any discounted cash flow, but just simply how long does it take to take back our investment? $80 in year 1, $80 in year 2, that's $160. $80 in year 3, that's $240. Well, we only need 200. So 1, 2 and a half, $40, that's $200. So it takes us 2.5 years to pay back the $200 for this company. For project B, it's even simpler. 1, 2, we get back the $200. So the payback is 2 years. So we see a pattern here in this problem. Project A is generating a greater present value and a greater profitability index because it's generating more money. Project B is generating a greater return in IRR and the payback. Companies look at the variety of these different returns to determine which investment is better. Net present value, internal rate of return, profitability, and payback. You need to be very familiar with these 4 methods. Okay, now that we've studied Chapter 8 and learned the 4 basic methods of determining return, net present value, internal rate of return, profitability index, and payback, now we're going to take a look at Chapter 9, which determine, okay, in this last problem, how did we determine what that $80 was a year? How did we determine what that $100 was a year? And that's determining the cash flow generated off the investment. Those numbers just don't come from anywhere. They have to be calculated and determined. And this is what Chapter 9 is about. And we're going to look at a problem in Chapter 9, problem 9-14 on page 296 and 297. This is a great problem as a template to determine this. So we're going to take a look at this. Let's take a look at it in the textbook. Revenues generated by a new product are forecasted to be as follows. Company is going to have a product that's going to have a 4-year life. That's its depreciable life. And it's going to generate $40,000 in year 1 in revenues, 30, 20, and 10. Okay? Expenses, as it goes on, expenses are going to be 40% of those revenues. Working capital required in each year is expected to be 20% of the revenues. And it requires an investment of $45,000 in plant and equipment. We're going to answer a series of these questions to put together the cash flow of this company. What is the initial investment? What is the depreciation? What is the project cash flows? What is the net present value? And what is the internal rate of return? So let's take a look at this. I can't stress enough how important it is to understand this specific problem. Okay, so I've set up a spreadsheet in problem 9-14, and I can't stress enough, from now on in our course, we're going to be using a lot of spreadsheets. So if you're having a difficult time with spreadsheets, be sure to let me know to get some help. So here's our problem 9-14 out of our textbook. It says it's a 4-year project. So 10 is the year of the investment. And in 4 years, it's generating 40, 30, 20, and $10,000 a year in revenue, sales. The investment is $45,000. That's how much we're spending today. Expenses are 40% of revenue. So I'll take 40% of revenues, and there's my expenses. And I'll just copy that across, and there's my expense line. They also tell us that the asset is an investment of $45,000 over 4 years with zero salvage value. So my depreciation then would be $45,000 divided by 4 years, straight line, $11,250. So my depreciation is $11,250 a year to fully depreciate that asset over its 4-year life. And look what my spreadsheet has done. It's taken my revenues minus my expenses minus my depreciation. Hey, look at that. It's just like we did in the problem in assignment number 1. My earnings before taxes is right here. Now I'm going to take 40% of that, which is our tax rate. Oops, sorry. Put in the wrong equation. There we go. Earnings times our tax rate of 40%. And there's our income tax. One thing I need to do though, remember this is a subtraction. So I got to make sure I put that in as negative 0.4. There we go. And I'll slide that down the years. There we go. So there's my taxes, 40% being taken out of my operating profits. And there's my net income. So I'm generating off this investment of $45,000, $111,000 of profit. But that's not the cash flow. It tells us in the problem that there's another type of expense that's incurred in investing in capital. It's called working capital. You have to spend additional cash to get that $45,000 asset up to speed. Inventory, receivables, payables, whatever. And it's always given by a formula. Well, in this case, they say that the working capital is 20% of the first year's sales, $8,000. And that's got to be negative 0.2 because that's cash flow going out. There it is. In other words, we're spending $8,000 need $8,000 of additional cash in year 0 to get this asset up and running, and it's called working capital. It's kind of like you ever buy a car and you borrow money to buy a car. Now you own the car. But how do you get the car driving? You got to get insurance. You got to get registration. You got to have maintenance. You have a lot of other upfront expenses to just operate the vehicle. That's what working capital is. So now that changes our total investment in year 0 because it's the investment plus the working capital needs of $53,000. Now here's the good thing about this financial analysis is that we're now going to get this $8,000 back over time as we use up that working capital. So now what we're going to do, remember, it says that working capital is always 20% of sales revenues. Well, 20% of 40,000 is 8,000. 20% of 30,000 is $6,000, right? That's the next year's revenue. And notice here I make that a positive. Why? Because it's what it's doing here is it's saying, okay, we're reducing our revenue. But it's not $6,000, it's the delta. In other words, if we take the change in revenue from year 2 to year 3, and I'll put that in the parentheses, equals this minus this. All right, that's $10,000. And I multiply that times minus 0.2, I get $2,000. In other words, now at the end of year 2, we take 20% of that. Our working capital now should be $6,000. Well, it is $8,000 plus the $2,000. What's the net? $6,000. In other words, we've reduced some of our cash flow of working capital because our revenue has decreased. Well, now we just copy that formula down the next few years. And in year 4, there's no year 5, so all we do is just take 20% of that, and it's 2,000. But here's the key thing about this, and you know you did it right. The net outlay of working capital at the end of a project should be 0. You spent it, here's your revenue base, and then revenue bases decrease. Thus, you give back that working capital all the way to the end of the project, and notice it's a 0. You've replenished, or you've gotten back the working capital over the course of the project. That's an important thing to note. It always should be net 0, but you're showing the proper cash being allocated in every year of the project. That can be confusing for students. Also, the final cash flow is we got to add back in depreciation. Our depreciation is $11,250, so we add that back in as cash flow because it's a non-cash expense. Remember that question we did in assignment 1. So now we have net income plus working capital payback plus our depreciation added back in, and notice here we have our total cash flows. And the total cash flows for the entire project are $164,000. Wow, that's even looking better. So we're spending $53,000 and we're getting back $164,000. That's pretty good. Well, what is that in our return calculations? They give us our cost of capital in this problem. Remember in the last problem we did in chapter 8, it was 11%. Now it's 12%. Formula, function, financial, net present value, NPV, just like we did in chapter 8. Our rate here is 12%, and the values are now from year 1 to year 4. We do not include year 0. C14 to F14. We're now going to discount that cash flow back at 12%, $128,000. Wow. Looks like we have a pretty good net present value. All right. Pretty good net present value. Let's do internal rate of return. Formula, function, financial, internal rate of return, IRR. There it is. And now we just paint the values from year 0 to year 4. 79.47%. Wow, we're making a lot of money on this baby. Our profitability index is the relationship of our discounted cash flow to our investment. A big ratio. And our payback in years. Wow, we're spending $53,000. Looks like we're getting it paid back in year 1, less than year 1. We're getting $53,600 back in year 1. So it's less than year 1. So let's just put it this way. Where's my little, so here we go. Minus less than 1 year. We're getting our money paid back within the first year of our investment. So that's a pretty good explanation of calculating the discounted cash flow and our return. The difference between this and chapter 8 is we're coming up with this data. And that's what we're doing. So I want you to see if you can look at this, and we're going to practice this more in the coming week. That's Chapter 9, Discounted Cash Flow, and this is in your attached to our lecture video for this week number 5. Okay, class, as I chalk one up for the absent-minded professor, as I went back and looked through this, as I finished, I put a pause on this video. I forgot to do a couple of things, and I'm glad I did that because this would really confuse you if you took a look at this. But remember, I put in the expenses as positive. Those expenses should have been negative. That's money going out. Revenues, positive. Expenses, negative. And I didn't put those in as negatives when I did the original spreadsheet just a few minutes ago. So notice what I've done. I've made the expenses being deducted. So there's our earnings before taxes. And notice in year 4, we're losing money. Then our tax rate. And notice in year 4, since we lost money, we get a tax refund. So here's our net income. We end up making quite a bit less than my original because I did an absent-minded professor goof and forgot to put the expenses and depreciation in as negatives because they're money going out. So not $9,000 of net income. Working capital stays the same. Depreciation stays the same. And now we have our net cash flows as being $62,000. We discount this flow of money over 4 years back at 12%. So we get $48,000. And notice how dramatically different this looks after I compensated for my professor goof in this format. We have a negative present value of 437771. The discounted, these 4 years discounted at 12% is $48,000. That's our discounted cash flow. Compare that to the investment. This is a loser. It loses money. Our discounted cash flow is less than the investment. Not a good investment. Our working capital now is 7.5%, dramatically below our cost of capital. We're losing money. Our profitability index is under 1, 0.92, not good. And look at our payback. It's taking us 3.11 years to pay back this $53,000, almost the entire life of the project to get our money back. So now in this case, this looking at it in these circumstances is dramatically different. We're losing money. And I'm glad I caught that error of myself. And this is how this correctly should look. Expenses are being subtracted. And now we get these scenarios. So please take a look at this again and with my corrected version here. And I apologize for that. That's what I get for trying to go too quickly in analyzing somewhat complicated analysis. Take a look at this. This will help you, and we're going to review it again in the coming week. So that's our lecture video for this first week of capital budget analysis. The net present value, internal rate of return, profitability index, and payback methods talked about in Chapter 8, and how to calculate our project cash flow, taking net income and adding and back and subtracting net working capital and depreciation. Please review that, and we'll talk more about it in the coming week. You have your assignment due on Sunday, and I will talk about this in my introduction video to week 6 that's going to be posted this coming Sunday. Thanks, everybody. Have a great week.